Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Wednesday, June 10th, and we're seeing some notable market pressure ahead of today's CPI release and ongoing geopolitical tensions. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant theme this morning is a clear risk-off sentiment driven by two major factors. First, we have tech stocks sliding ahead of the CPI inflation report that's coming out this morning. And second, geopolitical tensions are escalating with Trump's statements that Iran will pay the price for taking too long to negotiate. This has sent oil prices jumping and added significant volatility across markets. The Dow Jones futures are tumbling and we're seeing broad-based selling pressure. What's particularly concerning is the combination of inflation uncertainty and geopolitical risk hitting simultaneously. Markets hate uncertainty, and right now we've got it in spades. The tech sector is bearing the brunt of this sell-off, which makes sense given how extended valuations have been in that space.
That's a volatile combination. How are you reading the market's interpretation of these developments?
Markets are clearly positioning defensively. The interesting dynamic here is that we're seeing both gold and Bitcoin struggling, which tells you that even traditional safe havens aren't finding much traction in this environment. The Financial Times headline about gold and Bitcoin being the assets the rally forgot is quite telling. What we're witnessing is a flight to cash rather than alternative assets. On the corporate side, there are some mixed signals. We've got private equity firms like Ares raising $8.5 billion for new funds despite private market challenges, which shows institutional capital is still looking for deployment opportunities. Meanwhile, Meta is deepening its partnership with Ambani's reliance on AI data centers, indicating the infrastructure build-out for AI continues regardless of near-term market volatility. The key question for traders is whether today's CPI number will provide relief or add fuel to the fire.
What's your technical read on the major indices right now?
Looking at the technicals, the S&P 100 is testing important support levels and we're seeing some concerning patterns develop. The index is showing weakness below key moving averages, and if we break current support, we could see a move toward the next significant level down around 3 to 5% lower. Volume has been elevated on down days, which confirms selling conviction. For the Nasdaq, the picture is even more precarious given the tech-heavy composition. We're seeing a clear breakdown in momentum, and the index is approaching oversold territory on shorter timeframes. But that doesn't mean we can't go lower, especially if CPI comes in hot. The Nasdaq could easily test levels we haven't seen in several months if sentiment continues to deteriorate. The Dow Jones is actually showing relative strength compared to tech, which is typical in risk-off environments, as investors rotate toward more defensive, value-oriented names. However, even the Dow is under pressure and sitting near important technical junctures. The overall market structure suggests we need to see some stabilization soon, or we could be looking at a more sustained correction phase.
What does this environment mean for traders and investors going forward?
This is a time for patience and capital preservation. The actionable insight here is that traders should be reducing position sizes and tightening stop losses given the deteriorating technical picture and multiple uncertainty factors. For those looking at new positions, waiting for the CPI data and the market's reaction is prudent. We could see significant volatility in both directions depending on that number. If you're holding tech positions, consider taking some profits or at least protecting gains with option strategies. The sectors showing relative strength are utilities and consumer staples, which is your classic defensive rotation. There's also an interesting dynamic developing around the anticipated SpaceX IPO that Tom Lee mentioned, suggesting the tech dip could reverse afterwards, but that's speculative timing. For now, the trade is to be defensive, maintain higher cash positions, and wait for clearer signals. The market is telling us it needs to digest these concerns before establishing a sustainable direction.
Let's talk about crypto markets. Lizzie, what are the latest trends you're seeing there?
The crypto market is facing significant headwinds right now, and the outlook for next week is decidedly bearish across the board. Bitcoin is approaching those $62,000 local lows we've been watching, and multiple analysts are warning about potential drops to the $50,000 to $3,000 range based on historical four-year cycle patterns. What's concerning is that Wintermute is warning that Bitcoin lacks the inflows needed to confirm a market bottom, and we're seeing that Bitcoin ETFs have shown no growth since Trump's election victory, which indicates institutional interest is waning. There's $162 million in bid liquidity on the downside that could trigger a cascade if those levels break. The Federal Reserve decision and today's CPI data are critical catalysts that could push Bitcoin lower if we get hawkish outcomes. For Ethereum, the situation is even more precarious, with warnings of a potential crash to $1,000 if key support levels break. That said, we did see Bitmine purchase another 75,000 ETH, showing some institutional players are still accumulating, and both ETH and Sol were added to CME's new crypto index futures, which provides additional institutional access. Solana is showing a more neutral stance with some positive regulatory developments, as the Solana Institute CEO is pushing for the Clarity Act to protect open source developers, which is constructive for the long-term ecosystem. However, Sol is likely to follow broader crypto market sentiment. and right now that sentiment is bearish. The correlation between all three assets remains high, so if Bitcoin breaks down, expect ETH and Sol to follow.
What's the positioning like between institutional and retail investors in Bitcoin specifically?
That's a critical question because we're seeing a divergence that's quite telling. Institutional investors appear to be stepping back, as evidenced by the stagnant ETF flows and Bernstein's observation that Bitcoin inflows have slowed sharply in 2026 as investors chase AI opportunities instead. The lack of institutional buying support is one reason analysts like those at Wintermute are cautious about calling a bottom. Institutions tend to be more sensitive to macro conditions, and with the Fed potentially staying higher for longer and inflation concerns persisting, they're not seeing the risk-reward setup they want. On the retail side, we're seeing mixed signals. There's still enthusiasm around potential catalysts like the SpaceX IPO wave and regulatory clarity efforts, but retail traders are also getting more cautious as prices decline. The retail euphoria that characterized earlier periods has definitely cooled. What's important for next week is that without institutional support providing a floor, Bitcoin is more vulnerable to sharp moves lower on negative catalysts. Both groups are essentially in wait-and-see mode, which creates a vacuum that can lead to increased volatility. For traders, this means the next significant move will likely be driven by macro data rather than crypto-specific news, so keeping a close eye on traditional market indicators is essential for positioning in crypto assets.
That's a comprehensive look at the markets today. Remember, do your own research and consult with financial advisors before making investment decisions. These are volatile times, and having a clear strategy and risk management plan is more important than ever. If you found today's discussion valuable, please subscribe to the Morning Bell and join us tomorrow as we continue tracking these developing stories. I'm Robert, and thanks for listening.